The broadcast is now starting. All attendees are in listen-only mode.
Hi, everyone. I'm Scott Kessler, Director of Equity Research at CFRA, and I'd like to welcome you to today's webinar, Seasons Change, Sectors Change. During today's session, we will hear from members of CFRA's research team as we provide our latest market outlook just ahead of when most companies will report their third quarter results. Before we get started, I wanted to remind you that today's session is being recorded and a link to the recording will be made available later this week. During today's session, you may submit questions using the GoToWebinar questions panel, and we will try to answer as many questions as we can. Before we dive in, I'd like to introduce our panelists. Sam Stovall needs no introduction, but he is CFRA's Chief Investment Strategist, responsible for the firm's outlooks on the U.S. economy, stock market, and its 11 sectors. Sam is the chairman of CFRA's Investment Policy Committee and focuses on market history and valuations, as well as industry momentum strategies. Lindsay Bell is an investment strategist at CFRA. Lindsay has gained widespread recognition for market commentary and sector research and opinions featured in her Sector Intellect research available via CFRA's MarketScope Advisor platform. Lindsay works with Sam and CFRA's analysts to determine appropriate asset allocation and sector weightings. She also chairs CFRA's Portfolio Committee. And last but certainly not least is Todd Rosenbluth, who is Senior Director of ETF and Mutual Fund Research at CFRA, where he leads the firm's related holdings-based research efforts. Todd regularly publishes thought leadership on equity and fixed income products, maintains the quantitative fund models, and is a member of CFRA's Investment Policy Committee. I'm going to briefly provide some details about CFRA, and then Sam is going to give us his fourth quarter pep talk. I like that, Sam. Lindsay then is going to offer thoughts on sectors with a talk entitled Earnings Pop Again, and Todd is going to conclude by going through CFRA's views on ETFs with a presentation entitled Rotating to Risks on ETFs. After we go through the substantive slides, we'll do questions and answers, and then I'll wrap things up by telling you what CFRA has coming up next. Our clients and end users know CFRA, and increasingly so do many, many more. We have a history that dates back to 1927, and notably, the firm bought S&P Global's equity and fund research business 2 years ago. We are now one of the world's largest independent research firms. Importantly, CFRA is much more than single stock research. Our panelists today are strong evidence of that with their focus on market, sector, ETF, and mutual fund research. Our broader team also produces considerable sector, industry, and thematic content that is published just about every single day on average. And of course, we provide award-winning equity research using a unique and successful methodology. Many kinds of clients and end users, leaders in their industries, in fact, use our research to make more successful investment-related decisions. If you want to work with a research firm, you've come to the right place. Our focus is research, and we don't compete with our clients. We don't raise capital or gather assets or provide corporate access or have a bunch of other businesses and offerings. We're focused on research. Importantly, CFRA offers substantial scale in our multi-asset coverage. Our large and global team covers 1,500 stocks of companies from around the world. We also cover more than 1,800 ETFs. In addition, we cover all economic sectors and industries. With that very brief background on CFRA, let me pass things along to our Chief Investment Strategist, Sam Stovall. Sam?
Thank you, Scott. Yes, I'm going to talk about our fourth quarter pep talk, PEP standing for post-election pop, again referring to some historical analysis that I've done. As we see in the first slide, Right now, the economy seems to be firing on all cylinders, seeing very strong GDP growth, which is filtering down into strong earnings per share growth now that the third quarter reporting period is just getting started. Even though the Fed has raised rates 8 times, we are still in a stimulative monetary environment. Inflation remains relatively low. We've had a couple of successes in terms of revised trade agreements, and also just seems to be an absence of attractive alternatives. So despite the decline we've been seeing in share prices recently, which is, in our opinion, really just a resetting of the dials, which has been overdue, we are actually moving into a period that tends to be very favorable for stocks. As we see in the next slide, we are in the October through March period right now, but soon we'll be moving into November. And as we've learned from the Stock Trader's Almanac many years ago, the weakest 6 months of the year is the May through October period, highlighted in orange, up only 1.4% on average going back to World War II, and hence being given the old adage of sell in May and go away. Whereas the strongest 6-month period is in the 6 months of November through April, where the average price gain was 6.6%. So we have that to look forward to. Even a little closer to home in terms of timing, we are in the fourth quarter of a midterm election year. This is, on average, the strongest quarter of the 16-quarter presidential cycle, not only in terms of average price appreciation, but also frequency of advance. The market has risen nearly 90% of all fourth quarter midterm election years since World War II. The second and third best performing quarters are those that immediately follow. First quarter of year 3 and then second quarter of year 3, we tend to do fairly well because the uncertainty leading up to the midterm elections tends to dissipate, and investors then focus primarily on the fundamentals going forward. What about from a sector perspective? As we look to sector performances going back to 1990, which is as far back as S&P Dow Jones Indices has sector level data, I highlight 2 columns. One is the average price change for the 11 sectors in the S&P, as well as the batting average, the frequency with which they have posted price increases. Strongest returns have come from information technology at 6.5%, compared with the S&P 500's advance of 5%, followed by consumer discretionary up 6.2%, and then also seeing some strong performances by consumer staples, as well as industrials, and then materials close behind. In terms of batting averages, while the S&P was up 82% of the time in the fourth quarter, consumer discretionary, staples, and healthcare were up 86% of the time. We had financials as well as industrials up 82%, and then tech and materials at close to 80% of the time. What about this time around, though? Could we still see strong performances in this fourth quarter? Well, we are in the beginning of the third quarter earnings reporting period, and all sectors are expected to show increases either in earnings or in net income. We've looked at the communication services, and while the earnings comparisons are not meaningful because we're comparing a group of oranges versus apples, when looking on a net income basis, we do expect third quarter to be positive by about 15%. Lindsay Bell will be getting into greater detail on these sectors, but also looking for a majority of the sectors to post double-digit gains, and the weaker ones expected to show increases of 4% or more, with the market itself posting an increase in excess of 21%, and also looking for high teens for the latter part of this year, and then looking for positive growth into 2019 as well. But what about a year out? History would also say that seasonals are on our side. The post-election pop in 18 of the 18 12-month periods after midterm elections, the market posted positive returns. As little as a 3% gain in 2014 to as much as a near 34% advance in 1954. Average gain being close to 17%. What is interesting is I've highlighted in blue those periods when there was no change in the congressional makeup, but highlighted in orange those periods when we did have a change in congressional majority. So even though the pundits are now pointing to the possibility that the Democrats will regain control of the House of Representatives, history does say that, yes, the market still tends to advance, but by a lesser amount, on average closer to about 13% versus the 17% for all observations and about 20% for those in which the party in power has maintained the control in Congress. Also looking at things a little dearer to investors' hearts right now, and that is the relationship between Fed funds and inflation. What's encouraging is that we have never fallen into a bear market with interest rates being this low. Right now, we are looking at the blue line, which shows the differential, simply the Fed funds rate minus the year-over-year percent change in CPI. And we have never fallen into a bear market when this difference was below 0.83, meaning about 1 percentage point or so. Typically, we have remained in a bull market mode. Right now, in fact, Fed funds remains below inflation by about 25 basis points. So even when we do get the next rate hike in December, as we are projecting, that would simply bring us to a zero differential between the two, and we would need to see more than 3 rate increases before getting to a zone that would be challenging in terms of possibly falling into another bear market kind of an environment should history hold true. And obviously there's no guarantee that this kind of relationship will be maintained going forward, but we still feel fairly confident that in this low interest rate environment, while we could end up going through some near-term price adjustments as we're seeing currently, we don't think that it'll be morphing into a new bear market. Summarizing our outlooks, we are bulls at this point, but think that we're headed for a good year, not a great year. Our 12-month target is 3,100 on the S&P 500. Global GDP growth will probably inch higher in the year ahead to 3.9 versus 3.8. In the U.S., however, the fourth quarter over fourth quarter growth will slip from about 3.2% this year to 2.7 next year. Inflation we don't think is going to get out of hand, and the 2.3 average that we think for this year will come up to about 2.5% next year. Not a surprise, Fed funds rates will continue to move as the Fed has been indicating. The 10-year yield we think will be climbing, but will not be taking on the same trajectory that we've been seeing over the last couple of weeks. Oil prices will likely remain firm, as will the value of the U.S. dollar, but revenues are expected to come down by about 300 basis points as earnings are cut in half. So still positive, but certainly by a much lesser advance. So now the question comes down to, well, what do we do with this information? How do we invest going forward? Well, you know the old saying, the trend is your friend until it ends. If investors believe that others are too bearish at this point, and that the market tends to act like an incandescent light bulb and glow brightest just before it goes out, you might want to maintain a momentum approach. Here at CFRA, we do have a variety of portfolios that we offer to our clients, one of which is the industry momentum portfolio, where the top 10% of the industries in the S&P 500 are selected and then held on to until they fall out of the top 30%. Year to date through the end of August, this portfolio was beating the market by about 4.5%, beating the market by more than 9% on the trailing year, and outperforming on a compound rate of growth basis by more than 3.5% on a 3-year basis. So what are the sectors that are our friends, if you will, because of the momentum? The leaning is still cyclical. Information technology, consumer discretionary, and industrials are the primary exposures. We also have some exposure to some of the more defensive areas like consumer staples, healthcare, and utilities. So what the industry momentum portfolio would be implying is that you want to be buying and not bailing at this point in the market cycle. However, if you said, well, you know what, I'm a little bit nervous and maybe what I should be doing is rotating in a similar fashion to what was expressed earlier, where you stay defensive in that May through October period, but then get cyclical once we move beyond the midterm elections into that cyclical 6-month period. History says that going back to 1990, while the S&P was up 2.1% May through October, the defensive consumer staples and healthcare sectors posted average increases of more than twice that for the market. In the cyclical 6-month period, while the S&P was up a little more than 7%, the consumer discretionary, industrials, tech, and materials groups were up nearly 10% on average. So take that forward and say, well, gee, if this were a strategy where you were investing defensively May through October and then cyclically November through April, how would it do not only for the cap-weighted 500, but also the equal-weighted 500, small cap 600, and global 1200? The blue bars represent the compound rate of growth for the benchmarks as a whole. The orange bars represent the seasonal rotation custom index as prepared by S&P Dow Jones Indices. So you can see that whether it's a large cap, small cap, global standpoint, that this kind of rotation has performed well. If you want to learn more about investigating an investable product, please go to paceretfs.com to learn more about their seasonal rotation ETF. In summary, we like to call ourselves bulls, but with a lowercase b. We expect global GDP to be advancing ever so slightly in the year ahead. Earnings will be positive, but cut in half in the year ahead because the bar has been set so high. We don't see core inflation going parabolic and therefore the Fed requiring to chase in order to stay ahead of the yield curve. The Fed raised in September. We think they will raise again in December and 3 more times next year. We don't think that trade sanctions will morph into a full-blown trade war. And prior to this price slippage in the market, we had the Dow, the NASDAQ, and the S&P hit new all-time highs, which imply further price gains ahead. But lastly, we advise investors to moderate the price appreciation angle of ascent that we think we will see in the year ahead. So with that, I will now pass it over to Lindsay, who will go into greater detail on the expected earnings pop.
All right, thanks, Sam. I will go ahead and dig right into the earnings snapshot. This chart here really just shows us where we've been and where we're going. You can see that we're 2 years out of the last EPS earnings growth recession. It ended in the second quarter of 2016. You see the dip in those bars there. And we've come quite a long way. Second quarter of 2018, earnings growth of 25.2%. This quarter at 21.2% for the third quarter will mark the third quarter in a row where the S&P 500 has earnings growth of greater than 20%. We haven't seen that since 2010 when the market was rebounding from the financial crisis. There was, at that point in time, we were cycling extremely low or negative growth rate comparisons. This time the picture is much more different. Earnings growth is really being driven by solid tax reform and fiscal stimulus that aided in returning sales growth to the double digits, and also driving margin expansion. Our EBIT margins reached an all-time peak in the last quarter, and that was helped by that top-line growth, which I'll get into a little bit later. Buybacks also helped boost the bottom line to that 25% rate in the second quarter. What's interesting about the third quarter here is that we actually have seen numbers move down, earnings growth rates move down a bit going into the reporting period. It's down about almost a percentage point over the course of the quarter. Usually you see numbers come down by almost 400 basis points or 4 percentage points during that period. But the last 2 quarters, we saw numbers move up substantially. So we're returning to the normal trends within earnings. As the numbers usually come down, it makes it a little bit easier for corporate management teams to beat the consensus estimate going forward. Notably, earnings growth for 2018 is pegged at 21.9%. Sam touched on this. It's going to be reduced to 10% as we go out into 2019. You can see a couple of the quarters here on the right-hand side of this chart. And you've seen the trend there has also returned for earnings expectations to move lower as time goes on. The darker blue squares or columns currently represent where the estimates are now. We still are looking for a total of 20% earnings growth in the second half of 2018, but that's a little bit of a reduction from the 24% that we saw in the first half. All in all, a very strong showing is expected this quarter, as well as the fourth quarter. It will just start to taper off into 2019 as we begin to cycle the tax reform benefits and the fiscal stimulus that we saw this year. Moving on to the next slide, this is really digging into third quarter earnings growth by sector. You see currently the S&P 500, 21.2%. These are the 11 sectors that comprise the index. The cyclical sectors, once again, are going to lead. This is going to be the sixth quarter in a row where we've seen the energy, materials, financials, and technology sectors lead. Looking at energy, 92% growth. A lot of this sure has to do with the pop that we've seen in energy prices over the course of the quarter, but also the earnings recession that sector endured in 2015, 2016 was much steeper and deeper, and they're still climbing their way out. They were actually the cause for the overall earnings recession in the S&P 500. So overall, though, pricing should help this sector offset increasing costs. Materials, 42% earnings growth. That will also be benefiting from higher commodity prices as well as increased volumes as they begin to also benefit from the ability to take a little bit of pricing power. Financials, 39% growth. This is a sector that actually is up against pretty easy comparisons and also is a huge beneficiary from the tax reform plan. They're a very domestic business. So the 39% bottom line growth looks pretty impressive. Overall, JP Morgan, Citigroup, and Wells Fargo are going to come out with the results at the end of this week, really kicking off the third quarter reporting period. Well, we think the numbers will be good. There might not be as much to get excited about with regards to the banks in the quarter. Volatility was pretty subdued, which doesn't bode well for the trading businesses. M&A fees haven't improved. The backlog is solid there. Mortgages are down. Loan growth has still been pretty weak. We're really looking for management to see what they have to say about loan growth. And then also, obviously, a hot topic right now will be the yield curve. We've seen it expand in the last couple of days. How is that going to affect their businesses going forward? Technology, 24%. Bottom line growth. These four sectors, again, all having bottom line growth better than the S&P 500. Top line growth is expected to remain solid. In the second quarter, we saw sales growth of 10% for the index. This quarter, we're looking for a little bit of a moderation to 8.2%, but still anywhere in the 8 to 10% range is quite solid. We haven't seen that again since 2010-11 period, but this is being driven by a strong economic environment and not easy comparisons. Leading the charge on the top line, you will see the tech sector with 17.5% top line growth, consumer discretionary 17.6%, and healthcare at 16.6%. So quite significantly better than that of the index. The only two sectors expected to show top line declines are stable, declining 5.4% in sales, and materials down about 0.5 percentage point in the quarter on the top line. Staples, we've actually heard from a handful of staples companies already, and they're having a hard time taking pricing as raw material prices begin to move higher. So it's just kind of a tough business to be in. Amazon and even Walmart really are there competing hard. Turning to the next slide, what usually happens to earnings estimates as the quarter progresses, this is what this chart is showing us. The first, I guess it's the second column to the left, shows you where earnings estimates are at the beginning of the quarter. So for the third quarter, it would be, on July 1. Then the season start, which is where we're at today, as companies prepare to start firing off their results, and then what the actual final results were. And you can see in the final column, these numbers show you what the beat rate was versus the season start. So you're taking that final column, and what's the difference between that and where we were at the season start. And the history has been that the S&P 500 index earnings growth comes in about 3.5 to 4.5 percentage points better than the estimate at the season start. We take that range by looking at the 5 and 10-year average. The S&P 500 earnings number has not missed the initial expectations since 2009. It's been 9 years. So far, we're early in the season. 21 companies have reported. 91% of them have beat on the bottom line. When we talk about sales, 71% of those companies have beat on the top line. That's better than the historical averages of 66% beating on the bottom line and 50% beating on the top line. Usually early in the season like this, you'll see numbers coming in pretty impressively like this. I will note the sales number at 71%, while sounds very good, it's a little bit below the 87% beat rate we saw at the same period last year or last quarter. You might not quite get to that 10% sales growth rate. Also, guidance, overall has been a little bit mixed from those companies that have reported, mixed to negative actually. So you're seeing some companies start to talk down expectations for the remainder of the year. We're not so surprised by this now that we're halfway through the year. I think CFOs and corporate management teams have a better grip on what the tariffs mean for their businesses as we progress through the remainder of the year at this point in time. And our view is that no companies really are at a juncture, given the uncertainty that remains with what could happen with tariffs, especially with China going into 2019. They don't, CEOs aren't in a position to be overly confident right now and look to raise guidance. And there are headwinds that they are facing. A lot of companies are talking about logistics expenses or raw commodity prices that are impacting the cost of their business. And as we know, you hear in the news, the jobs numbers have been great. Wages are starting to go up. They're not spiking, but that will certainly weigh on margins going forward. I will note in the course of the last couple quarters, you see in this last column here, the beat rates in the first and second quarter, 700 and 566. Those are pretty solid beat rates. Remember I said on average you see 3.5 to 4.5% beat rates. It's the first time that we've seen numbers this high since going back to like 2011. It's a big beat, especially when you take into consideration the amount that these numbers moved higher going into the earnings season. Anyway, if we do get that average beat rate, we could see close to another 25% earnings growth rate quarter, but the question will be what does the outlook look like? That's really what's going to drive stocks. And with that, let's take a look at the valuation of the S&P 500. Currently trading at 17.4 times on a forward 12-month basis. It's trading at a premium, as you see here, to the 5-year average of 17 times. In 2017, so just last year, the market multiple on a forward basis averaged 18.3 times. So we're down from that, and you can see on the right-hand side of this chart that the numbers have come down significantly from the start of the year. There was a sharp drop out at the end of January when the market was spooked by the potential for higher rates and higher inflation when it was unprepared for that. But the reason that the multiple has remained in, the 17-ish area for the better part of the last 4 or 5 months is because earnings estimates have been going up. So as the market has moved up, the S&P 500 is up about almost 8% on a year-to-date basis. the market multiple has remained subdued because we've seen the fundamental strength of corporate earnings growth improve. To the extent that that can continue, the market multiple can remain reasonable. Stock reactions, though, currently to the earnings that we have seen so far hasn't been so great. Companies that have reported and beat both on the top and the bottom line are seeing their stocks the day after they report move down about 20 basis points. And that's with the top and bottom line beat. Like I said, if they miss on both of those, the story's a lot worse. On average, you're seeing the stock go down 8.5%. So expectations are high going into the quarter, I think. And all eyes are on the outlook. When we look back at history over the last 8 quarters, how the market reacts to earnings season, it's been a little bit muted unless there's a major move one way or the other before in the month to 2 month period before the earnings season starts. And this quarter, from mid-August to early October, we saw the S&P 500 up 4%. Now, in the last week, the market also has pulled back 1%. So maybe you want to say since mid-August, the market is up 3%. That's still pretty good. So, I'm not expecting a lot of positive reaction, even on good numbers, at least in the month after earnings season begins. So, hopefully we find some stability and comfort in what CEOs are saying. And the results that we get and the fundamental strength is confirmed, but stock market reaction may be a little bit muted from my opinion. So let's dig into the 2 of the sectors that I want to cover. Communication services sector, I'll go through these quickly in the interest of time. I know Todd has a lot to talk about. Communication services sector, I just wanted to take a quick look at this because this was a sector that was, it used to be the telecommunications services sector. It got a renaming and a rejiggering. We got a bunch of new industries to accompany AT&T and Verizon and Charter Communications. It was a small, kind of boring, slow growth sector with the addition of social media companies, traditional media companies, some software gaming companies. It's kind of a much more different, vibrant industry that reflects really the changing way that we communicate across the globe. But now it's also a sector that has different characteristics. It's much more cyclical. It's much lower yielding. The dividend yield on the communications services sector used to be 5.4%. Now we're looking at about 1.7%, which is under the S&P 500. The beta is higher. But the volatility of this sector, believe it or not, is very low, which is similar, the one similar trait to the old telecommunications services sector. This is just kind of a pie chart of who's in the new sector. Alphabet, which is Google's parent, and Facebook, they make up the majority of the sector, 45% of the market cap. AT&T and Verizon make up 20%. So these 4 companies are really going to drive the direction of this sector from a price performance perspective as well as an earnings performance perspective. So those will be the key companies to watch as earnings reports occur. Turning to the next slide, this is kind of just another way to break down the market or the new sector. Technology represents about 53% of the communication services sector. And so will be a key driver. Within there, you've got some, outside of Facebook and Alphabet, some of the gaming companies like Activision, Blizzard, and Take-Two, and even Twitter's in there. So that's part of the composition. Consumer discretionary and technology both donated about 21% of their previous market cap to this sector. So you're seeing that equal about, just under 30% of the new sector. Overall, we don't have earnings per share like Sam alluded to, so we put some pro forma numbers together here, and we're expecting earnings or net income growth of 15.7% for this new sector. It should stay solid through the end of 2018, 16% growth in the 4th quarter. And again, just like the rest of the market, it's going to taper off. So for 2018, you're looking at 17.2% net income growth, dropping to 19.5% in 2019. So that's just kind of a quick overview of that sector and what we're looking for. And finally, I want to take a look at the technology sector, because this, like I said, they donated 21% of their market cap to that new sector. We're still looking, though, for this earnings growth of 24% for technology, which you saw is in the top 4 best earnings growth rate expectations for the S&P 500 index. This sector, widely talked about and watched, is up 15.5% year to date, but since the start of September is down 3.5%. Only the REITs and consumer discretionary performed worse since the beginning of September. So we're viewing this market as having kind of a low bar going into the reporting period. A lot of that has to do with this bar on the left here, semiconductor and semi-equipment makers. 22.8% growth sounds great. It's a deceleration, though, from what we've seen over the past 6 quarters in the 40-50% range. And the semiconductors stocks have really been under fire. Micron actually reported already. The problem within the semis has been any semiconductor company or equipment company that is exposed to end markets related to memory, and that's what Micron's bread and butter is. They're just seeing it's a supply and demand issue. Average selling prices have come down. There's margin headwinds. They actually mentioned tariffs. But, you know, we do believe there are some companies within this industry that do have potential upside. AMD, NVIDIA, you know, you just got to be focused on the growing end markets that these companies focus on, like gaming and servers. When we think about technology, the important thing to think about is the fact that Apple and Microsoft now make up almost 40% of the market cap of this sector. Now that you have heavyweights Apple and Google out of the picture, Apple was always a key driver, but now at 21% market cap, what they do for in the coming quarter is going to be important, because about 14 to 19% of the sector's earnings growth, so that 24% information technology sector earnings growth, 14 to 19% of that is coming from Apple. So that's going to be one to watch. Microsoft also, expectations are solid for these companies as far as earnings go going into the quarter. Both have performed well on a year-to-date basis, but our analysts believe that there is upside here. Just also one more note on the semis is numbers for that group. Like I said, the 22.8% is kind of an impressive number relative to a lot of other sectors. But when you look out to 2019, analyst expectations are currently for 3.7% earnings growth in 2019, coming off a 26% earnings growth year in 2018 is the current expectation. Just 2 months ago, the expectation was for 6.1% growth in 2019. So that's been like cut in half. So again, expectations for the sector, in our opinion, have come down substantially. And then finally, to prove that point out, the last chart that I want to take a look at is really, this is the technology sector. The blue bars show what the estimates were going into the earnings season for the tech sector overall, and the orange bar shows what actually happened. And as you can see, the actual results have been substantially better for the tech sector than what expectations were going back for quite some time. If you just average out the estimates in the past 2 years, as you can see, because the gap has been widening, the numbers are coming in almost 800 basis points or 8 percentage points better than initially expected. Admittedly, this quarter might be a little bit of the tougher one, especially with the reshuffling and the issues in the semi space. But if we get, 5-6% better than initial expectations, you're going to see a 30% growth rate on this sector. So that's why we remain overweight tech going into earnings. So with that, I'm going to pass it to Todd Rosenbluth, head of our ETF and mutual fund practice, and he's going to go into some investing ideas for you.
Thanks, Lindsay. Great to be here with everybody. We'll just jump straight in to show you about the state of the ETF market. Really strong year for the first 3 quarters of 2018. You can see the pie. We're approaching $4 trillion of total assets, in part with over 200 billion of net inflows in the first 9 months of the year. What we've seen that's a bit different this year versus in prior years is the pie is expanding in part based on fixed income ETF demand. We've seen nearly $60 billion go into U.S. fixed income ETFs, a smaller chunk going into international fixed income. At the same time, we've seen growing usage of ETFs for U.S., primarily U.S. equity as opposed to international equity, in part based on the relative strength of performance between those two. On the next slide here, we're headed into, or we're now in the fourth quarter. The flows data that I showed doesn't reflect that, but the fourth quarter has historically been a very strong one for the ETF industry. You can see the step up that tends to take place in the second half of the year, and in particular in the fourth quarter. Some of that has to do with the performance numbers that Sam highlighted earlier. The fourth quarter tends to be a strong one, and then people tend to do rebalancing and positioning and are increasingly embracing ETFs. Now, on the next slide here, just to catch you up on the way that we rate ETFs, how that's different than others in the industry, and then I'll get to some specific examples of ETFs. We leverage the great research here that Scott talked about earlier of our fundamental analysts and our forensic analysts to do a bottom-up approach. We think that adds a forward-looking aspect to our research that's different than the other research providers that are out there. We leverage the great capabilities of a team of 75 analysts for both forward-looking valuation metrics as well as risk assessments. We think, especially in an environment where we're now going into another year of the bull market, you want to be conscious of the risk characteristics of the portfolio. We really think that not only understanding the holdings, but also the historic volatility can be important. And then increasingly, especially in the fixed income space, as we've seen fixed income funds on average be down this year, costs matter. The higher expense ratio, the wider bid-ask spread, these are things that can eat into a return and eat into your clients' portfolios. We favor funds that have lower costs, and those are metrics that we use within our rating methodology. On the next slide here, we'll just show you visually how our rating methodology is driven. And if you've long been using our stock research, you know that to us, STARS is the stock appreciation ranking system that's here, and that's contributing to our overall rating, as well as the risk assessment that's taking place from our stock analysts. We rate over 1,100 equity ETFs using a model that looks like this, based on not only forward-looking valuation and risk considerations of the portfolio's holdings, but other metrics like the expense ratio, technical trends, and trading costs. And then most importantly, before I touch on specific ETFs, we rate hundreds of ETFs that have launched in the last 3 years that are continuing to gather assets. When you know what's inside a portfolio and you know what it costs, you can provide an opinion and you can determine whether or not that's appropriate. As we jump over here to the next slide, Lindsay touched on the communications sector. Let's talk about how you can get exposure to that. There's a relatively new ETF that launched in 2018, part of the State Street Sector Spider family, known as the Communications Select Sector Spider, XLC. It had almost no assets heading into September. It added $1.3 billion in September ahead of or as the GIC change was being implemented. And investors got exposure to the stocks that Lindsay talked about, your Alphabet, your Facebook, in addition to AT&T, Verizon, and some consumer discretionary stocks as well, including Charter Communications and Netflix. I won't spend too much time on the industry breakdown here, but to highlight, there's another pre-existing ETF known as the Vanguard Communications Services Index ETF, VOX, that has been out there. What happened earlier this year is it changed from the Vanguard Telecom Services Index ETF to the Vanguard Communications Services Index ETF. The ticker stayed the same. The expense ratio stayed the same. What happened is it slowly added in and has continued to add in those new technology and new consumer discretionary stocks. Not surprisingly, the yield has gone down, but it is not exactly identical to what you get with XLC, and so it's a reminder you really need to look inside the portfolio. Now, on the next slide here, let's talk about broader growth sector ETF or growth-based ETFs. Sam talked about a number of different sectors that historically have done well in the fourth quarter. So we wanted to highlight ways you could play that theme, but also being mindful of what's inside the portfolio can be different. Now, these are index-based products, not active, and so even though they didn't make any changes to their sector compositions, you can see here we're pulling data that includes GICS changes such as the communication services sector, Schwab U.S. Large Cap Growth, and the SPDR portfolio S&P 500 Growth. Two very low-cost products, two products that look at growth from a different perspective. You can see a much more sizable weighting into the technology sector for the SPDR portfolio S&P 500 Growth, and less exposure to communication services. Now, the difference that's here is Microsoft is part of the SPDR S&P 500 Growth, whereas it's not a constituent of the Schwab U.S. Large Cap Growth product, and as such, the sector exposure is going to be notably different. I would point to users of our MarketScope Advisor platform that we wrote up the Schwab U.S. Large Cap Growth ETF as our focus ETF of the month for the month of October. You can learn more about why we like that ETF on the platform. And then on the next slide here, let's just talk about a momentum ETF. Sam talked about the trend being your friend and a momentum portfolio that we have on the MarketScope Advisor platform. You may also own or maybe considering owning MTUM, which is a momentum ETF that you can find that's out there. We think it's increasingly becoming known as a growth style of portfolios. And you get similar exposure to the cyclical sectors, or some of the cyclical sectors tied to that you find in the Russell 1000 Growth, technology and consumer discretionary. What's interesting to us is just 5% of this ETF is in the new communication services sector. We like the stocks inside. You'll see examples of those on the screen here. We also like how cheap it is, 15 basis points, which even though we're not comparing ETFs to mutual funds, it's notable how cheap it is versus the average actively managed mutual fund. And now lastly, on my last slide before I turn it back over for questions, and we thank you for submitting questions, this is what you'd find on our platform, two different flavors of our ETF research. On the left-hand side is a sample of our ETF report, the Consumer Discretionary Select Sector SPDR. XLY was a prior focus ETF of the month. On the right-hand side is an example of our thematic research. The commentary that Lindsay and that I write come out through thematic research, and you can find that on the left-hand side of the MarketScope Advisor platform, or the ETF-specific commentary you can find by clicking on the ETF tab of MarketScope Advisor. And if you don't have access to that, please let us know in the question box. We'd be happy to get you turned on to trial that part of the platform. And Scott, let me turn it back to you because I know we've got some questions that came in.
Thanks a lot, Todd, for some great content, and to you, Sam and Lindsay, as well. I thought the slides and the insights were really excellent. So, Todd, you're correct. We received a number of questions that we're going to try to go through at this point. Just to remind everyone, if you have a question and you want to try to get it to us, feel free to use the GoToWebinar questions panel, and we'll try to answer them either in the context of this webinar, or maybe we'll follow up with you at another time. All right, so a bunch of different questions have come in. I could go in a few different directions here. I guess one question that came up that I think is worth us trying to address is your global strategy the same as your domestic strategy and positioning? And before I kick that over to Lindsay to try to answer, I want to make sure that people understand that on MarketScope Advisor, which is our platform where we publish and distribute our research and content, we actually have an investment strategy tab. And if you go there, you can actually see our investment policy committee notes pertaining to the U.S. as well as international, and we actually produce European and Asia Pacific IPC notes. With that, Lindsay, did you have anything you wanted to add in terms of the substance of the question about the global strategy?
Yeah, I mean, what I would say is within Sam's U.S. IPC notes, which are in that same section of Market Scope Advisor, the Investment Policy Committee comes up with a recommendation of asset exposure, and the current recommendation is 45% exposure to U.S. equities, 15% to foreign equities, 25% to bonds, and then 15% to cash. Within the foreign equities, what we would say is that 15% allocation should be split 50-50 between Asia and Europe. We have a neutral rating on both, each with separate risks that are actually described in those investment policy notes, the IPC notes. There is a separate note for Asia Pacific and a separate note for Europe. We have overweight rankings on different sectors within each region. For example, in Asia, we're overweight financials, industrials, and materials, but underweight communication services, real estate, and consumer discretionary. And the reason we remain neutral on Asian equities is because we see risks actually rising, especially with uncertainty around global trade. There's weakening momentum in China. Some manufacturing data out this week was weak, and then earnings per share revisions have been to the downside. So that's where we stand on Asia. In Europe, we're actually overweight the energy, financials, and tech sectors, and underweight healthcare, industrials, and communication services. We have teams in both regions that actually drive the decision on sector weightings. But the reason we also remain neutral on Europe and don't favor Europe over Asia is because they have their own risks, a lot of which are political in nature. The global trade concerns also weigh on this region of the world, and then we also are expecting to see more weakness in economic data. So that's kind of where we stand, and those notes go into great detail on the explanation for that.
Great, thanks, Lindsay, for a very comprehensive response. Again, I point people to Market Scope Advisor, the investment strategy area, for more information about our investment policy committee notes for the U.S. and internationally. So we received a number of questions related to two broad topics that are connected, I think. One is related to the value of the overall market. Do we think the market is overvalued? Clearly, if you look over the last couple of days, we've seen some choppiness. And one of the reasons I would argue for that choppiness, or some of the negative performance of stocks over the last couple of trading days, is because of interest rates and the increase that we've seen. I saw that the 10-year note was above 325, which is the first time I've seen that in a long time. So a couple of related questions to that. Maybe, Sam, this first one is for you. How do you think about the U.S. market right now in light of just overall valuation metrics that you look at and think about, and in the context of much higher interest rates than we had just a few months ago?
Well, Scott, interest rates obviously are very, very important for a variety of reasons. First off, when analysts use the discounting mechanism of interest rates to come up with net present value, intrinsic value of underlying stocks, the higher the interest rate, the lower that these individual stocks are worth, and as a result brought up to the S&P 500 level, the lower the market itself is worth. Higher interest rates also mean that companies that issue debt will have a reduction in earnings because of an increase in interest expense. And then lastly, higher interest rates go, the greater the substitution attractiveness of these higher yielding securities become. So when we had treasury yields that were below 3%, below 2.5%, people were looking more toward higher yielding equities, looking to get both growth and income. But now that we are starting to see interest rates move up, I think investors are sort of wondering, well, what do we do now, and could it lead to a bear market? Well, let me put things into perspective. Historically, the Fed funds rate has been above the year-on-year change in CPI by an average of 1.3 percentage points. Today, the Fed funds rate remains below the rate of inflation. If this were a normal time, therefore, we should be seeing a Fed funds rate that's closer to 3.5% than it is hovering around 3%. Second, we would be looking for a 10-year yield that's a full percentage point on top of that, or close to 4.5%, not us getting worried about the Fed funds rate being at 3.25%. Also, looking back in time, what I found is what was the average monthly percent change in the S&P 500 during a variety of ranges for interest rates. On average, the S&P gained 1.5% whenever the Fed funds rate was less than 3%. Between 3 and 4, it actually increased, that the S&P's average price appreciation was 1.8%, but then started to slip once we moved higher than that 4% threshold. We only slipped into negative territory, however, that line in the sand, once the 10-year yield went above the 6% level. Obviously, there's no guarantee that that's the kind of threshold that we would need to see before this market on a sustainable level went into the red. And I think that's what's causing investors to be concerned is, gee, we really have been in a very, very low interest rate environment for quite some time. Do the old rules hold for today? Taking that one step further and looking at sector returns in a rising rate environment, again, going back in this case to 1970, what we did was we computed total returns for the underlying sectors based on individual stock performances. We found that the best performers were some of your lower yielding cyclicals like information technology, consumer discretionary, and industrials, outperforming the S&P 500, as well as your inflation hedge sectors such as energy and materials. Not surprisingly, some of the defensive groups, which are higher yielders, underperformed the S&P in a rising rate environment, particularly financials, real estate, and consumer staples. Lastly, the only sector that actually posted a decline on average in a rising rate environment was your bond proxy utilities group. So what we're finding is some similarities, some differences, but what I think I'm reminding investors about is we're still in a low interest rate environment relative to history, relative to inflation itself. We are in a stimulative environment and will need another rate increase just to get to a net neutral monetary platform. So I think that while, yes, we could easily experience some undulation in prices, maybe even slip into a pullback in prices, I don't think that we are likely to be heading toward a bear market anytime soon.
Great. Thanks a lot, Sam. I'm mindful of the fact that we are literally at the top of the hour, but we have a number of questions to go through, and maybe we'll spend a couple more minutes attempting to address those. So let me deviate a little bit from the series of questions related to market valuation and interest rates and pivot, at least for this particular question, to Todd. So Todd, I actually heard you participate in a podcast recently that was really informative, that went over, I think, 20 different questions or topics related to ETFs. And I think one of them was either about or related to actively managed ETFs. And so this question basically asks for you to discuss any actively managed ETFs that you or we at CFRA find attractive.
Yeah, so, well, thank you for the compliment. And for those that want to do that, to take a look, I think you're referring to a podcast I did with Bloomberg called Trillions. Folks are more than welcome to listen to. So we cover actively managed ETFs the same way that we look at traditional ETFs. The vast majority that we rate are fixed income products, in part because that's the way most of them, that's what's out there in the marketplace. So your actively managed ETFs will include things such as short-term products like Mint, M-I-N-T, And then JP Morgan has a pretty successful, relatively new actively managed ETF, JPST. It's a short-term, ultra short-term product ETF that's out there. We previously, I think, have talked about Davis, which runs actively managed mutual funds, and now recently have launched ETFs. So DWLD is an example of that. We've seen Vanguard enter the actively managed ETF world with some factor-based ETFs, active smart beta ETFs. VFVA would be an example of that. And Legg Mason, which has a broad suite of both active equity and active fixed income mutual funds, and launched initially with passive products, has been rolling out actively managed ETFs recently. I think about a week or so ago, they launched a Western Asset Management Core Bond Fund, which is pretty exciting to see a proven bond manager that has historically not had an ETF presence enter in that space. So those are just examples of some of the ETFs that we've got on our radar, and many more for folks that have access to our platform.
Thanks a lot, Todd. And by the way, Todd literally gave that response completely off the top of his head, which I think is a testament to the work that he does day in, day out, and the value that he provides to CFRA's clients and end users. All right, so one more. It's kind of a compound question, so I might need multiple people to jump in here. The question goes back to rising interest rates, but the focus, and this will be the last question or series of questions, and if we're not able to get to your question, we will look to follow up with you offline and try to provide a thoughtful response. So with an ever-increasing Fed funds rate and a pullback in small caps, what is the outlook for the rest of the year and into next year? I'm guessing with respect to small caps, more specifically. Sam, do you have any thoughts maybe on small caps and rising interest rates and some thoughts on that? And Todd, maybe if you know of a small cap ETF or two that might be worth mentioning, that would be great.
Going back to the outlook, we do have a slight overweight on the small cap arena. This category is expected to post earnings of 33% growth this year versus less than 22% for the S&P 500. For 2019, small caps are expected to show a 21.5% gain in earnings, more than twice that of the S&P 500. When we look to relative PEs, we are looking at small caps that are trading below the longer-term average relative to the S&P 500. And I think that because the small caps have been beaten up quite badly recently, and their divergence, I think, sort of hinted at this most recent pullback in prices. Because we're not expecting a bear market, I would tend to think that they are going to be among the better performers heading out of this kind of digestion of recent gains. I think the real question is how aggressive the Fed will have to be, because the larger the company, the bluer the chip, the easier they will be able to get loans going forward. Small cap stocks do tend to have a harder time convincing their banker to let them borrow some money that they would need in order to expand should the bankers start to get worried. But I think what we're finding is that a lot of banks have been easing their credit conditions. If you go on to the St. Louis Fed's FRED website, you'll see that there has been a slow reversal in the velocity of money, that we are seeing a slight pickup in terms of loan growth, et cetera. And so I would tend to say that that would be supportive of small cap stocks.
And I would just add to that this morning the NFIB Small Business Confidence Index or Optimism Index came out, and while it took a little dip from August's all-time high in September at 107.9, it's been the longest track record in the history of the index for it to be in such positive territory. And within the details of the index, small businesses are talking about capital spending increasing, and they're actually also increasing wages to get the workers to fill the positions they have open. So the small businesses are still very optimistic about their future prospects at this point in time.
This is Todd. I'll just chime in. I think the data that Sam was initially citing was the S&P 600 as his reference point. So IJR is one of the ETFs that's out there. That's from iShares that tracks that. If you wanted to go with a more growth-oriented, as if you didn't have enough growth from the small cap side of it, Vanguard Small Cap Growth is VBK, and that's an ETF that tracks a different benchmark overall than S&P index that we're talking about. Vanguard uses CRSP that's there. So Scott, back to you.
All right. So I think we're going to wrap up here by saying thank you on behalf of the entire team at CFRA. Thank you for joining us today. Later this week, you'll receive a note from us with a link to the replay and the slides from today's session. We hope you'll join us again soon for another webinar that's coming up soon. Find profitable options trades based on your strategy, where CFRA will be joined by Investors Observer to provide insights on how you can develop option strategies and marry them with CFRA's powerful research and screening tools to help make successful trades based on criteria important to you. In the meantime, please check out CFRA's Market Scope Advisor. We referenced it a number of times over the course of the last hour or so for our latest research, insights, and opinions. And at any time, if you have questions related to CFRA and our research or our research team or anything else, don't hesitate to contact us at cservices@cfraresearch.com. Thanks a lot and have a good day.